60 years of British oil production could end with a single sale. And this morning, Tuesday the 4th of August 2026, BP's chief executive said something remarkably blunt: the North Sea is simply not competitive. That was not an offhand remark to a reporter. It was the justification for a decision BP confirmed last Friday, the 31st of July, to put its entire UK North Sea business up for sale. Analysts put the likely price at over $2 billion, roughly £2 billion. Around 1,100 people work in that business today. Now hold on to that word, uncompetitive, because it tells you BP is not offloading a broken asset. It is offloading a working one, because the same money earns more somewhere else. So what actually changed? Tax, mostly. The Energy Profits Levy, the windfall tax brought in after gas prices spiked in 2022, pushes the headline rate on North Sea profits to 78%. Compare that to the 25% a company pays on ordinary UK profits, and you see the problem instantly. The current government extended that levy and tightened the investment reliefs that used to soften it. Back on the 3rd of June, The Telegraph reported BP was already weighing an exit. Layer on restrictions around new exploration licenses, and the sum becomes simple. If you cannot easily drill new wells, and 3/4 of any profit goes to the treasury, you are managing decline at a punishing rate. Capital migrates to the Gulf of Mexico and the Middle East instead. The immediate human impact lands in Aberdeen and along the northeast coast. 1,100 BP jobs are not automatically lost in a sale, because a buyer normally takes the staff with the assets. But new owners restructure, and late-life fields get run leaner. That uncertainty is why the SNP demanded decisive action from ministers within hours of the announcement on the 31st of July. The industry body Offshore Energies UK has long put the sector's total employment footprint across the country at roughly 200,000 roles, spread through engineering firms, boat operators, and helicopter services. Those suppliers price contracts years ahead. When an operator the size of BP signals it is leaving, orders get delayed today, long before a single deal is signed. Where does this head? Expect the buyers to be North Sea specialists rather than global majors, because the majors are all making the same calculation BP just made. Firms built specifically to squeeze the last barrels from mature fields, the likes of Ithaca Energy, Enquest, or Serica Energy, are the natural bidders, possibly backed by private capital. The sticking point will be decommissioning, the legal duty to safely plug wells and remove platforms at the end of a field's life. That bill runs into billions across the basin, and whoever carries it will discount the purchase price accordingly. So the headline £2 billion could shrink considerably. Realistically, a process like this takes months, meaning a completed deal is a story for 2027, not this autumn. Here is the point to carry away. BP leaving is not evidence that the North Sea has run dry. It is evidence that Britain has made its remaining oil less attractive to invest in than oil almost anywhere else. That is a policy outcome, not a geological one. For BP shareholders, this is discipline, freeing cash for higher returning projects. For the UK, it means production and skilled jobs shift to smaller, more thinly financed owners at exactly the moment those fields need careful management. Watch two things over the coming weeks: whether any bidder makes a firm approach, and whether the Treasury signals movement on the levy. Those two signals will tell you far more about Britain's energy future than any political speech.